Right, it's May 27th, 2014. This is for myoptionsnet.com, and today we're going to be talking about why we use options and why we spend so much time focusing on options. And we're studying John and Pete Najarian, their book, and it's called How We Trade Options: Building Wealth, Creating Income, and Reducing the Risk. And having read this book, as well as another book, which I would recommend that everyone gets, is a book by David Kaplan called The New Options Advantage. And these two books, I believe, will set you up to be able to trade options effectively and efficiently. And then going through some mentoring, maybe with OptionView, or with Dan Sheridan, or John and Pete and their team. This is the first paragraph out of their chapter in part 3 about why we use options. It says trading stocks is reasonably easy, at least in theory. If you think a stock is going up, you buy it. If you think it's going down, you sell it, or sell it short if you think you're a real risk taker. If you think a stock is going nowhere, sell it or avoid it in the first place. The stock price is what it is, and that is what you pay. Things are not so simple when options trading. Many factors influence the value of an option contract. It is for largely that reason that most retail options traders underestimate the challenge of making money with options. On the other hand, I believe that this is just my opinion, away from the book, I believe that most traders lose money in the markets. And in many cases, I think it's because they don't have a firm grasp and a clear understanding of the benefit of using options to protect their trades or to actually be their trades. John goes on to say, would you like to increase your leverage without paying margin rates, profit from dropping prices with limited risk, generate more income in your account, get paid to enter long stock positions, insure your positions, or even your whole portfolio? Options are extremely versatile. You can do all the above with the use of options. Now he goes on, he's got some fine print, some disclaimers and this and that. Most options are a financial instrument that represent a stock or an index or an ETF or maybe even a Forex product, but we're going to be sticking with this on the stock side today. And that contract controls 100 shares of that stock, and it's good until a defined expiration date. The price at which shares can be bought or sold also is defined by the contract. It is known as the strike price. There are two types of options, of course. There's calls and puts. A call gives you the right but not the obligation to go long for a particular strike price. A put gives you the right as the buyer, same with the call, it's for buyers, and for the puts for buyers, the buyer has the right but not the obligation to go short for a particular strike price. The price that you pay for that option is called the premium, and the reason why people use options because there's so many different strategies that you can do. You can build strategies to make money in uptrending markets. You can build strategies to make money in downtrending markets, and you can build strategies to make money in sideways markets. As we've seen, although today gold broke down a little bit, but for 2.5 weeks or so, gold has been in a pretty nice range. And so for a couple weeks, people could trade options in gold using a strategy called what I call a neutral option spread, or a non-directional trading. That would be selling a call above the channel. Let's say the channel is at 1310. Well, it's really about 1307, but let's say we were selling calls out above 1310 and selling puts below, let's say, 1280. And they had a June or either May or a June expiration, we probably could have made some pretty good money in that particular strategy. even in a sideways market. Now, the market did have some oscillations where there was an opportunity to make some pretty good money. However, with the market moving, the average true range, I believe, is still around $14.50 per day. That's a pretty hefty range. That means that you can make or lose up to $1,400 per contract in that particular one-day session. And now that's pretty hefty trading. Now most people obviously are going to have stops that are going to be much less than that. You have to be pretty determined to ride a trade for more than the average true range of, it doesn't matter what market it is, whether it's corn or soybeans or gold or silver or crude oil or a currency or whatever it happens to be. The idea with options trading is that you can do a variety of things. For instance, when he talks about getting paid to enter long stock positions, let's say you have a portfolio, let's say you have $100,000 in cash and you're looking to put 50 or 60 or 70% of that into equities. You have a pretty good idea of what equities you want to buy, but you think they might just be a little bit high right now, or you'd like to get paid to buy those options or to buy those equities. Well, how can a person do that? If you sell a put below that, you get to collect a premium, and if the stock comes down to, let's say a stock is at $50 today, and you'd really like to buy that stock at $45, well, if you sell a $45 put for every 100 shares of the stock you want to buy, let's say you want to buy 1,000 shares of that stock, and you want to pay $45 for it, and after that you're not really that concerned about where it goes. Well, one of the things you can do is you can sell a put, and the put you would have to, if the buyer buys the put, they've got the right but not the obligation to go short from that position, so you have to go long from that position. And so if you're looking to buy the stock at $45, sell the $45 put, you pick up $1 or $2 per share on it. Okay, you just, if you're buying 1,000 shares, you just pick up $1,000, and if it never comes down to $45, well, you get to keep once the options expire, you get to keep the $1,000. And if it does come down there, well, you just got paid an extra $1. You instead of buying it at 45, you actually bought it at 44, because you got paid to buy that stock at $45, which is what you were interested in doing in the first place. And these are just some unique little ways of taking advantage of options. But there's a number of things that a person can do. If a person thinks that the market is going up, but they don't want to work with margin with a margin account, one of the things that they can do is they can buy a call. Now, as the options go up, as the stock goes up, the options will go up somewhat, even if they're intrinsic. Intrinsic means that they're in the money. So if you're looking to buy a stock at $45 and you buy a call at $45 and it goes up to $50, you're $5 intrinsic. Now, will that option go up $5? No. The option will go up in value somewhere around 51% of the move. So if the stock goes up $5, the option is going to go up a little over $2.50. And the way that we know how much the option is going to go up in relation to the underlying asset is what we call delta. It's one of the Greeks, and it's a formula for figuring that out. And at the money call is almost always 51% in delta, and an at the money put is almost always 49%. And so we can tell how much the underlying option is going to change in relation to the change of price in the underlying asset. So some people might think, well, this XYZ stock that's at $45, I think it's going to go to $55. I want the full $10 of profit on it. So what do? Well, they buy let's say they buy a put for $2, and at $45 they go long the stock, and then they sell a $55 call. Now, the reason why they sell the $55 call maybe is to offset some or all the expense of the $45 put, and then they've got the stock. So if the stock goes from $45 to $55, they get the lion's share, almost all of that money. And anyways, it varies from asset to asset and what the volatility is and that type of thing. Right now, we're seeing the implied volatility. If you look at the S&P 500, for example, the VIX, or the volatility index, is incredibly low. This is the lowest it's been. Well, I believe it's 7% of the time the implied volatility has been lower than this. So this is an extremely low period of time for volatility. And if you've listened to our earlier webinars, one of the things it talks about, that we've talked about before, is that when the volatility is low, that's when you want to be a buyer of options. But when the volatility is high, that's when you want to be a seller of options. Now, another thing to watch out if you're looking to sell options in the markets right now, I was going through and scanning markets today. Most of the stocks and most of the, well, I should say a lot. I didn't scan 18,000 different issues, but a lot of the stocks and a lot of the issues, the indices that I looked at and the assets I looked at today, a lot of them, the volatility is quite low. In fact, the implied volatility is significantly lower than the statistical volatility. That is never an option selling period, because the statistical volatility, as soon as that pops a little bit, the implied volatility is going to inflate. And if you sold those options and the market starts moving against you, all of a sudden, what you sold for $1 might be worth $1.50, $2, and you might have to make good on that. So you have almost an instant loser. So, anyways, the idea is that buy options when the volatility when the implied volatility is low, or well below statistical volatility, and statistical volatility is in a normal trading range, and sell options when statistical volatility is in a normal trading range and the implied volatility is significantly higher than the statistical. You want to watch the implied volatility. That is the volatility that option traders need to really pay attention to. Excuse me 1 second, I need to get a little drink of water here. Sort of blow dust. Okay. One of the components of option valuing is time value. Time value in options is a lot like term life insurance or automobile insurance. So if you buy your automobile insurance and you pay your premiums 6 months at a time, that premium is going to be a lot more expensive on day number 1, 180 days before renewal date, than it is going to be at 15 or 20 days before that policy expires. Well, in a way, that's very similar to the to options on stocks, because as time goes by, the time decay is pretty much linear until the last 30 to 45 days. Generally, at around 30 days, that's what we call falling off the table. The time decay erodes the value of that option much more rapidly and it becomes almost exponential. Now, buying a call and buying a put, it defines your risk. Uh, and so if you are risk averse, then options can be a very nice instrument. It's a very inexpensive way to get into a position. Again, each option is it's got a definite lifespan, has a definite expiration date, and the options are going to be priced accordingly. The more time value they have, the higher the price is going to be. And the other thing is that or another thing about it anyways, is that options, rather, if you go out and buy 100 shares of Google at $600, you're putting $60,000 into a position. If you buy an option, you're controlling $60,000 worth of stock, and let's say that is $2 for the option, $2 for the call, or maybe even $3 for the call. But in any case, if that's the case, you're spending $300 to really control $60,000 worth of stock for a period of time. For a period of time, that is your stock. Now, do you have to actually exercise that option and take that stock? No, absolutely not. It gives you the right, but not the obligation, to go long for a call from a particular price point, and it gives you the right, but not the obligation, to go short for a particular price point. So options are a very unique creature. They give you tremendous leverage. If you're trading stocks, what's the best leverage you can get normally? What, 2 to 1, right? Where with options, you can see in that particular example that we just pointed out, that in that particular example, you may have had leverage of 200 to 300%, or 200 or 300 times actually, so much more than 200 or 300%. And so a small move with that with Google, if Google goes from $6 or from $600 to $610, if you had bought 100 shares, the most you can make is $1,000. Okay, which $1,000 on $60,000 is what, 1.5%, a little over 1.5%, 1.75% maybe. Where if you had bought the option for $3, so you got $300 in it, and the 100 shares go up $1,000, you've more than tripled your money. So you can see that options can oftentimes give you tremendous leverage, and it makes it where you're actually able to participate in any market that anybody else, pretty much anybody else, is participating in, as long as it's an exchange-traded asset, as long as it's exchange-traded stock and so on. So those are some of the reasons why people use options. It gives us tremendous leverage. It can limit our downside risk, and it as long as we pay attention to volatility, there are strategies for us to take advantage of uptrending markets, downtrending markets, and sideways trending markets. Again, if we found a market that was moving sideways, and they do, historically, I believe I've read before that markets move sideways about 70% of the time in sort of a sawtooth sort of a pattern, and so they form a bit of a channel, just like with gold right now, where the channel was 1280 to 1307, and it just kept rattling around in there, going back and forth in there. So you'd sell a call above it and sell a put down below it. Not too much time left on it, and It was, one of the things a person could do is for a sideways market like that, as I had explained just a few minutes ago, you can write options. In this industry, you can actually sell options that you don't own. You can sell a product that you don't own yet. You don't have to go out and borrow the shares or lease the shares from people or anything like that. Now, not all brokerage firms are going to let you sell naked options, but many will. And and the more they can see that you're an experienced trader and you are aware of what you're doing, then they'll be more apt to allow you to do more. Most people are trading online now, I believe, and so I think I think that the brokerage firms and clearinghouses are a little afraid of taking risk, and they are taking risk. If they're selling, if you're selling a naked option, if you were if you're selling an option for XYZ company, a $50 put to somebody from another company that is from ABC company that is buying the put, and that stock goes from $50. Let's say you're high flyer and you sell 20,000 of these things, and which represents 2 million shares of stock, and then and the stock goes from $50 down to $25. Someone's on the hook for $50 million here, and if you don't pay, the clearing firm pays, and so clearing firms have some risk. And so that's why they monitor options selling extremely closely, because they know that potentially you both could be on the hook, not just the clearing firm, but or not just you, but the clearing firm as well. And so that's why they have people sign personal guarantees and so on. Sometimes people are offended by that. That hey, what are you talking about? You don't trust me. Well, no, they don't. To be just very candid about it, they don't know you from Adam. And we had a client years ago who was hedging crude oil on the Mississippi. And I know that this is not quite a stock story, but it's a similar story. And he was starting to trade options. He wanted to hedge his position and that type of thing. And he was selling options against this load of crude oil, this barge of crude oil that he claimed to own. Well, once we started digging into it, one of my brokers had taken the trade, and he was brand new, so it wasn't really his fault. He was brand new. The fellow that was supposed to be monitoring it, managing it, was asleep at the wheel, and was just a terrible manager. And he was a great broker, but just an awful manager, and really couldn't give two hoots and 80s about anyone but himself. And so this poor fellow, he was fresh off the boat from England, and started working with us. And so he didn't really understand a lot of this stuff, and didn't really understand the way Americans do things. And he also didn't grasp the idea. He'd been a cook for a chef for a Formula One race team previous to this. So he was not really around people that really snookered people, kind of like this guy was trying to do to us. Well, when I first saw the trade, I came back in the evening, and he was still there, and everyone was still there at the office, as we normally would work till about 8:30 or 9 o'clock every night. And so everyone was still there, so I asked him about the trade. He told me about it. And the client had put in 50 grand, and he used it all to sell options and to cover this crude oil trade. So I asked the broker, well, what if this market goes up? How far can this market go up before he's into us and before he has to send money? And if this market moves just a little bit, and he said, well, I don't really know. And I said, well, then this is not a trade you should have taken, and you should have been advised that by the supervisor here, and that kind of let you swing in the breeze. But this being your first big account and all this, well, it's a nice account, but we're going to have to call them right now, and we're going to have to close out some of these positions. Well, the client moaned and groaned and screamed and cried and carried on. Well, I don't remember how I was able to get a hold of his bank account information, but the guy had about $12,000 in his bank account, and that was it. He had 12 grand, and this was a multi-million-dollar position. And I explained to him that, if this position moves just a little bit, because you've extended yourself so far, you are going to, just a little bit of a wiggle, and we're going to have to close out the positions. And he moaned and groaned, oh, you can't close out your positions, isn't it? Well, yeah, the brokerage firm actually can close out your positions. The instant you don't meet the margin call, bang, they can close you out. But there's always the possibility that they can miss it. And so clearing firms don't like the idea of taking that risk of relying on that platform to ensure their liquidity. So a nice way of saying covering their fanny. And anyways, this fellow moaned and groaned, and I called him back and said, look, you got 12 grand in your name, and you're taking a shot at this, and if this works out, you're going to make millions. If it doesn't work out, you're going to expect me to pick up the tab for millions, or the clearing firm to pick up the tab for millions. And I don't know about the clearing firm, but I had to sign personally when I open up my account, my brokerage firm. You have to sign personally to the exchanges and to the regulators that you'll make all debts good. I'm not risking my house. I'm not risking for my family's risk. And I think most brokers would feel pretty much the same way. And so anyways, we closed out some of the positions, and he was really unhappy. And a couple days later, oil spiked, and his account got thrashed. But we would have been thrashed as well had we not lifted those positions. So anyways, it's a long story short, not to tell you the war stories, but the idea is that brokers are ultra sensitive to things because the markets can move very dramatically. I doubt if in 2008, in August and September 2008, people really felt like the market would continue going down. In fact, if you read some of the quotes from the crash in 1929, Bernard Baruch, who was financial counselor to presidents and leaders of industry, and was just supposedly a wizard, had sent a message not long after the initial crash in 1929, indicated that that was it, that in the next week they expected the stock market to start going up. Now that might have been just propaganda or wishful thinking or whatever. But in any case, he sent that to, I think it was the Prime Minister or the King of England when he sent that and issued that statement. And so it wasn't just Bill selling it to, this idea to Tom or Frank to Bill or John or a couple of buddies at the oil changing station. These are heads of state that were communicating these things. So I would think that they actually believe some of it. And this can show you how wrong they are. In fact, there's some websites out there. If you ever want to read some interesting things, and these were the experts. These were the Janet Yellen's and Barack Obama's, and the Bernanke, Ben Bernanke and Alan Greenspan, and those types of people, and the talking heads of our time. That's what those guys were. And if you read those quotes from 1929 and 1930, all the way through 1934, you'll see that these people, and some of them well educated, some of them were our head of our U.S. Treasury, some were connected with the Federal Reserve. Well, the Federal Reserve didn't really have the death grip on the country that they have today. Well, death grip might be a strong term. I don't know if it's really a death grip, but I don't really see that they're doing a whole lot of good. But anyways, all that aside, The idea is that if you're going to be selling options, you need to have a relationship with a brokerage firm, and don't go crazy at the beginning. Build up to it. It's a nice way to make money, but it's also a good way to take a spanking. There's an old saying about option writing that you climb the stairs and fall down the elevator shaft. In other words, with selling options, you make a little bit this month, a little bit next month. You make 2 or 3%, 3.5%, 4%, something like that, and you just, it's a nice way to make good money. But when you have to be very, very nimble when things start rolling back against you. You have to be very quick, very nimble, and unless a person is in front of a screen, if they're traveling, we've had clients that hop on an airplane and head to South America or head to Europe, and they're on an 8 or 10 hour flight. Like, close your positions before you ever take a flight like that if you're selling naked options. Because if you're going to be writing options or selling options, which is synonymous, writing options, selling options, if you're going to be doing that kind of thing, you need to be available. Or you need to give your broker power of attorney with written directions, and you need to write those directions via email and have him or her respond. They've gotten those directions, they understand those directions, and if the stock moves to a particular price, or if the volatility inflates, or a number of conditions, that he or she will be exiting that position for you at the earliest convenience. Or it'll just trigger a market order, which if the market is very, very liquid, which I would only write options in liquid markets. In other words, where there's a lot of trading volume and a lot of interest. I certainly wouldn't do it on any penny stocks. Although penny stocks are pretty popular right now, and they have been for a long time. There are people that make fortunes in penny stocks. Most penny stocks are frauds, in my opinion. I can't really prove that, but from what I've read and from what I've learned, most issues in penny stocks are absolutely nothing. They are they're pump and dump, what they call pump and dump things. They'll send out PR, public relations, news wires or news indications, and they'll pump up the stock and get a lot of people motivated to buy it, pump it up while they're selling their stock. So I would stay away from penny stocks as much as possible. Although we have some advertisers that have some interesting penny stock plans. So I looked through their plans, and one of them, well, actually two of them, I think are actually pretty darn good. But you have to be really careful with penny stocks. There's very little wiggle room. When those things collapse, it seems like there's nothing but hair underneath them. It's like jumping out of an airplane. But again, it's just my opinion. But anyways, back to the options deal. Obviously, there's not going to be any options on penny stocks. They're just, in most cases, they're just not the volume. And I don't know that you really want to do anything with options in penny stock anyways. But the thing to keep in mind with options trading is that options trading gives you an opportunity to take advantage of tremendous leverage. Now, leverage is a two-edged sword. It can work for you and it can work against you. So it has to be moderated and it has to be monitored, and you have to have chronicle points, and your trades must be scripted so you can manage your money properly. And if you're selling options, if you're buying options, well, sometimes I put on spreads and I ride them all the way to the ground because, well, once I put the spread on, I usually will go for an option spread that is $200 or $300 or $400, and up until the very last day, I still have an opportunity to make money. So who knows? So I've had it before where I've had trade where I put a spread on and it decayed and decayed and decayed and sometimes I've bailed because I didn't want to give up too much of that $300-400, uh, and then other times I've stuck, stayed in there and had that thing turn out to be a big winner for me. And I've also gotten out of them where I should have stayed in, and it would have been a winner. So you never really know. I just got out of a trade just a couple weeks ago on the E-mini where we did that. It went down, unfortunately. We were doing a butterfly, and unfortunately, the all the options were going up in value. The options that we sold were going up in value, so the spread itself really never gained very much value. And it did go down. Of course, the E-mini went down about 1808, and I was short from 1845. Now, one would think, okay, you got 30 points in there, and almost 30 points in it, 28 points in it, 27, or 37. So isn't that pretty darn good? Well, yeah, it would have been if it would have been really close to option expiration. Unfortunately for me and for my clients that I was trading that for, it happened with a lot of time value on it. So the puts, or the puts that I sold, were going up almost as fast in value as the puts I bought. And so, but that's the life of options trading. You just can't always pick them right. And the great thing about options trading is that the entry the entry cost oftentimes is so little. I've had butterflies that cost me virtually nothing over the years. Almost nothing. $50, $100, where if the butterfly works out, maybe I make 2,500, as much as 2,500, or more. And I've bought options in the past that I bought them for $200, $225 that went up to $84,000 a piece. And well, I had probably 150 or 200 clients in some options that did that. We had 3 in a row like that in about a 90-day period, and none of the clients wrote any of them very high. I think the highest we got in one option was around $3,400 to $3,500, and then we sold everything. And the one client, he had a dream to have a small engine repair shop, so he took all of his winnings and said, "That's it, one trade. I'm going to go." Now all of a sudden, I can buy my lawnmower repair shop, and that's what I'm going to do. So he said, "Well, good for you." There are not many people who will take 1 or 2 trades. If they get lucky and hit the jackpot, they just will walk away. But congratulations for you and for your self-discipline. But anyways, options are a wonderful way to trade. There are a lot of strategies that you can use. And I was telling Sandy just before we started this today that I'm going to find out now. John and Pete Najarian are actually giving away this book, How We Trade Options. So I'm going to call their company tomorrow. And if I can't get a hold of someone there that can do this for me, I'll go to their website and get the link. And then I'm going to put that in tomorrow afternoon's newsletter. So anyone that wants to get this free book, I think it was like $9 for shipping and handling, which, it doesn't cost $9 for shipping and handling, but it covers the cost of the book, the production of it, and the shipping. So in any case, it's still very, very inexpensive, and there's a tremendous amount of wisdom in this book, as there is in David Kaplan's book. And if you're serious about trading, and if you've got any money in the markets, you're serious about trading. These are 2 books that should be in your trader's library. They should be on your bookshelf, and they should be marked up, and they should be all highlighted with highlighters for this and that. These books should almost be completely eaten. These should be so well digested that I think that they are critical. Before you do any mentoring or buying any of these $1,000, $2,000, $3,000, $5,000 seminar things, get these books, because even if you're still going to go to those seminars, you're going to know so much more and get so much more out of the seminars by reading these guys' books. In fact, Sandy and I are talking about putting together a seminar. It'll probably be in the $3,500 to $4,500 range, and it'll be in the spring of 2015, where we get Dan Sheridan and John Najarian and maybe James Hogan from OptionView, and get a couple other people and bring them down for a weekend, or like a 3-day seminar here at one of the nice hotels. There's some beautiful hotels here in Naples, and it'll be during the wintertime, so most people love to come down here during the wintertime or the springtime. Great golf, if you're a golfer. Beautiful fishing if you like to fish. You just like going to the beach. It'll be a beautiful time on the beach. There are great restaurants here in town, and so on. So if that's something that's of interest to you, keep that in the back of your mind. That might be coming up in March, April-ish of next year. And we have to talk to our old buddy Bob, who does meetings like this, and see what we can do to work something like this out. And we'd have to run to see what kind of interest we would have before we start laying out money for conference rooms and the things we'd like to do, and to get some of the people down. And we'd like to get some interesting celebrities to come by, and it's never too difficult to get them to come to Naples in the wintertime. It's one of the more beautiful areas of the country, while everyone else is shoveling snow and doing all that kind of stuff. So anyways, that's it for why we trade options today, and that's our first. We're going to put together a series. I numbered this one, so this is number 1. And I appreciate you guys coming out. I know you guys will be doing a lot of things tonight, and if you guys hopefully you had a nice Memorial Day yesterday, and hopefully nobody watched the Blackhawks. That was a disturbing loss last night to the LA Kings, and boy, I'll tell you, if they don't play a little bit better than that coming up, they're cooked. So, anyways. Thanks for spending some time with me, and I appreciate your time, your energy, and I'll put a link to where we can get these books. Where you can get these books for about $9 a piece, and they are worth 10 times that, 100 times that. They're worth a fortune. The wisdom you'll get from these fellows. Even if you don't trade options, reading these books is going to make you a better trader in the other things you're going to be doing, because it's going to explain the markets much better. And options, I think that the option traders are the savviest of traders. They, because technical analysis is involved, volatility is involved, forecasting volatility, time value, understanding when the market expires, all that kind of stuff. That is all part of being a good option trader. And if you're going to be a good option trader, and if you're going to really take it seriously and you're really going to get involved in it, you might want to look at OptionView. And if enough people are interested in OptionView, we'll get James from OptionView to come on one night, and we'll do a little interview with James, and you'll be able to throw some questions at him and see if you can stump the expert. He's been with OptionView for a long time. He's my go-to guy whenever I have questions, and I've been using OptionView for 14, 15 years. And I don't know everything about OptionView, but if you do decide that you want to buy OptionView, I'll help you as much as I can. And if I can't answer any questions, well, you'll know that you can always talk to James, because James is absolutely brilliant with this stuff. So, I guess it's a question and answer time. Does anybody have any questions? Anything I can help you with? Or any questions about options trading?
Nope, it doesn't look like any questions.
Alrighty. All right, very good. Well, have a nice evening, and you'll get the newsletter tomorrow. Thank you.